welcome to another episode of Market Talks. Today, we will be talking about how bonds are back in the spotlight. Over the past 2 years, bond markets have witnessed higher volatility, reaching levels not seen since the 2008 financial crisis. So what are the causes for this high volatility in bond markets? What are the implications for bond investors? And how have we at Banque de Luxembourg positioned our portfolios in this rapidly changing environment? After the great financial crisis in 2008, most central banks adopted highly accommodative monetary policies aiming to stimulate economic growth following the recession. However, this era of exceptionally low interest rates reached a tipping point in 2022. So after the unprecedented period of global shutdown due to COVID, economic activity bounced back pretty quickly and strongly. This led to inventory pairing, longer delivery times, and tension on the labor market. So the combination of all these factors, coupled with a surge in energy prices due to the war in Ukraine, fueled inflationary pressures. Initially thought to be temporary, this inflation proved to be higher and more persistent than expected. This prompted most central banks of developed market economies to initiate the fastest rate hiking cycle seen in decades. For instance, the European Central Bank has raised its deposit rate from negative 0.5% in July 2022 to 4% last fixed in September 2023, which makes it a little over a year for ECB interest rate to increase by 4.5%. Rising interest rates have profound implications for bond investors. When a fixed-rate bond is issued, the coupon, and therefore its initial nominal yield, is determined on the basis of various factors such as short-term interest rates set by central banks, inflation expectations, the bond's maturity, and the issuer's solvency. Once issued, the bond is free to trade on the market, with its price and yield fluctuating based on supply and demand. So just to illustrate, if interest rates climb, then newly issued bonds arrive on the market with coupons that are higher than those of existing bonds. As a consequence, the price of the latter falls as investors sell them in favor of new ones offering a better return. The opposite also applies. When interest rates drop, the price of the bonds already in circulation rises. The extent to which prices move varies according to the bond's maturity. So a change in interest rates will have a greater impact on the price of a longer-term bond than on one with a short-term maturity. The surge of inflation that prompted main central banks of developed countries to embark on one of the most aggressive tightening cycles in decades resulted in a historic bond crash in 2022, with prices dropping by more than 15% depending on the segments of the bond market. Thanks to our underweight exposure to bonds, particularly to long-term bonds, we were able to limit the impact on our defensive investment portfolios. As interest rates started moving higher, we seized the opportunity to gradually build up our bond allocation and also increase our duration. This gradual approach reduces the reinvestment risk. Undeniably, the current highly attractive returns on term deposits make it very tempting to stick with these short-term investments. However, there is a considerable risk of finding ourselves back in a low interest rate environment when it's time to cash in. If interest rates keep rising, putting money in short-term deposits will pay off. But if interest rates fall, locking in a higher yield over a longer period of time will prove a much better investment decision.